Buying an investment property is a huge financial decision, so it's important to use an experienced agent that knows your market. Few people have as much knowledge about investing in the Okanagan region as AJ Hazy. AJ and his team have guided many local investors towards financial freedom and can do the same for you. From pre-analyzing properties to negotiating the purchase and even property management after the sale, AJ and his team at Vantage West Realty provide all the services you need as you build your portfolio. Anyone can become a real estate investor. Let AJ Hazy show you how. I'm Scott.
All right, we're here. We got some people already on. Welcome, welcome. Let me get back to the title slide. I was worried that Scott McGilvery thing was just going to keep looping forever, and I was panicking. I was texting my tech guy going, how do we stop this? So I'm glad that we got it worked out. I'm really excited about tonight, guys. Appreciate you guys spending some time with me. I know there are people from all across Canada and different time zones, and this is either an incredibly convenient time after work or an incredibly inconvenient time after dinner, depending on where you guys are. So I will play full out for you guys and make sure to give you a very healthy return on your investment of time in me tonight. Before we get rolling though, I just want to have you guys just drop a message in the chat, to make sure that you know how the chat works, that it is working. Let me know where you're from. And I'd also love to know, what number one real estate goal you've got for the year. So if you don't mind, let's all test out the chat real quick. And let's see where we got people joining us from and what people are hoping to be up to here in 2025. Hello, hello. Hey, Iskander, good to see you, buddy. Christine, hello, right from here in beautiful Kelowna. Awesome. Thanks for joining. Would love to know what you're hoping to get out of tonight. Nicole, how you doing, girl? Nice to see you. Megan, nice to see you. Sammy, good to see you, pal. All right, we got folks from Regina, Penticton. Oh, wow. Joining from New Zealand. Thanks, Paul. I appreciate that. What time is it there, my friend? We got Jessica. Hi, nice to see you again. We'll definitely want to see you get that second property. That's awesome. Terry, old friend, good to see you, buddy. Nice to see you from Salmon Arm. Old Josh from Penticton just had a new baby. He's playing some hooky right now. He's got the door closed, so doesn't have to hear that crying. Love it. Paul, good to see you, my friend. 2 p.m. there, yeah. Hey, Shane. How you doing, my friend? Shane's one of our investors in the limited partnership. Good to see you, partner. Right on, right on. We got more and more people piling on here, so we'll just give it a few more minutes. Mariah from Calgary. Hello. Hello. Wow, we got a nice diverse group of folks tonight from all over. I feel blessed that you guys would give me your attention for the evening. I promise to make it worthwhile. Megan, good to see you. 2025 goal is restructuring. It's a good time to do that. I believe that you got to do that when things are a little bit calmer, and this is that calm before the storm, and it's a good time to restructure, you bet. What else are you guys hoping to accomplish? I'd love to know primarily what you hope to get out of tonight so that I can make sure that I try to weave that into the presentation as we go. I obviously take my best guess at what I think you guys want to learn, but fire in some wants or some wish list things that we might cover tonight, and I'll see if I can weave it in on the fly. Christine wants to explore some different strategies. Yeah, you bet. Well, we're going to expose you to a few tonight and open it up to Q&A at the end as well. So if more people want to, go deeper on certain items or figure out what else there is, I've got lots of tricks up the sleeve. Nicole, best way to start leveraging. I love that word, leverage. You bet we can do that. Paul's looking to scale. Perfect. You're in the right room. Right on. Learn strategies to build a real estate portfolio, what to avoid, what to look for. Perfect. We are going to cover all of that and then some. That's awesome. First of all, I appreciate you guys being interactive in the chat. That means a lot to me. And for you guys showing up, kudos to you. We had over 150 people register for the event, and usually get 1 out of 3 people that say they're going to be somewhere actually join. So kudos to you for being part of that small cohort of people who does what they say. Mike, just getting started. Very interested. Right on. And Harvinder wants my perspective on the future short-term rental ops in Kelowna. Yeah, I know they were restricted. They may not be in a very short amount of time. We will see. Well, right on. I want to get started here because we're 5 minutes past the hour, and I'm really hoping I can get everybody out of here within an hour. So let's rock and roll. Tonight's agenda, we're going to talk a little bit about the new reality. I'm going to give you a very brief version of our market update, some stats that'll help you understand kind of where we are in the market cycle. Then I'm going to talk about the tactics that will work best in this market. I'm going to go through a few creative deal structures that you may not be aware of, and joint ventures, which I think are something that a lot of people would benefit from understanding better. I'm going to share a couple market opportunities and then hopefully leave lots of time for a Q&A so you can ask me anything, get a chance for some free coaching. Now, for those that want to go deeper, all of you guys were presented with the option to upgrade to the VIP pack, which gives you access to the very tools that I use to analyze deals on a daily basis. It would give you a front row seat at the first investor course that I've done. So finally, after all these years, I'm actually going to do a course, and you would be the beta group to go through that. Signed copy of the book I've been working on for over 3 years, and lifetime access to this particular workshop was the offer in VIP. I appreciate the VIPs that did upgrade. That goes a long way to helping us cover some of the costs towards all the advertising we did to get all you folks here. And then also, we do have an upcoming in-person event. It will be in late April. I think we're targeting April 25th as the date for that. And I've got a special offer for you guys coming up if you stick with me until the end. So, investing in a changing market. This was an event that we did last year in roughly September. Who was at that event? If you don't mind, throw it in the chat. Let me know if you were at the event, if you had a good time, because that is the event we're looking to build upon. We'll be filling the Innovation Center right where you see me on stage there. We'll be filling it again and bringing you some never taught before content I think you're really going to enjoy to help you guys plug that stuff right into your real estate business. Now, I don't want to assume anybody on this call. I mean, some of you work with me and some of you are already partners, but many of you are seeing me for the first time. So I'll introduce myself properly. My name is AJ Hazy, and I am the founder of the Vantage West group of companies here in Kelowna, BC. We have completed roughly $3 billion in residential and commercial sales. Over at our property management side, we manage over $1 billion worth of rental property. We have been through over $100 million of pre-construction project sales and also done over $100 million in development and construction ourselves. And I now have the privilege of managing some capital on behalf of some limited partners. Been in this gig for over 22 years, and I've amassed 4 licenses. I'm a salesperson, a managing broker, a licensed property manager, as well as a licensed developer, and also carry the credential of what is called a real estate investment advisor through the Legacy Council of Canada. I have had the pleasure of being a writer and a contributor to Canadian Real Estate Wealth magazine. A lot of you guys probably know that magazine. That's how I met some of you on this call, actually, is you reached out to me through the articles that I've read. I have had the endorsement of Barbara Corcoran, the HGTV Shark Tank star, for over 12 years, as well as HGTV star Scott McGilvery. And I've also been featured on Bloomberg TV Canada. So I'd say all that, not to impress you, but rather to impress upon you that I'm not new to this game, and real estate investment is very much my baby. Now, I put out market updates on YouTube quite often. If you guys actually are subscribers to that, I appreciate that. We would love to grow our subscriber network on that as well. So if you would like to stay up to date on the market, I put out one of these market updates. I try to do them every month, at least every other month, where I do a deep dive into the stats and share which way I think the wind is blowing. And if you go back in time on YouTube, you'll see I've been right far more than I've been wrong. We've also got a pretty cool little event coming up called our Ugly House Tour. We used to do this back when flipping homes was a little bit more in fashion. And this is where we actually get on a bus with a group of investors, and we go out and I curate 5 properties that are in fact very ugly. And we drive around and we look at them, and then we tour them as a group. And then between homes, I break down what my strategy would be to maximize the value and how I would profit and how I crunch the numbers. And I really go through all of the steps that I would go through as an investor myself. And so that'll be just following the in-person event here in Kelowna. We will probably just take the VIPs to on this tour, on the Ugly House tour, as we can only take about 25 people. Now, I respect that a lot of you guys are coming into this conversation at a different place. Some of you are diehard DIY folks. You want to do everything yourself. You don't even use realtors and you don't use property managers. You do everything yourself. I get it. And I think you'll still take a lot from this. Some folks like to hire professionals and have more of a done with you approach. And some folks want to be completely hands off and have more of an armchair investment. In any case, you are in the right place. This will apply to you whether you fit any of these three avatars. And these really are our primary customers. The Vantage Group of companies is designed to be a one-stop shop. So we are an ecosystem where we have obviously the real estate investment advisory, where we can consult you on residential or commercial sales. We have property management. We've got home services to perform, renovations. We've also got the pre-construction and project sales for the developers that want to bring projects to life. And we do our own development and construction and manage some partner capital as well, which also partakes in the development and construction that we do. So it's a one-stop shop. It's a full ecosystem, and we are most certainly open for biz. So although this is a free event, I hope that we can bring you enough value that you might consider using one of our wonderful companies for your next project. I'd love to connect with you guys. If you want to stay in touch, best way to do that is via LinkedIn. I have found I answer my messages there. It's direct access to me, and we can carry on the conversation there. I'd love to connect. Okay, this brings us to the market update. So I'm going to give you a quick crash course on where we are, and then I'm going to help us locate ourselves on what we call the real estate cycle clock. So this year, especially in January, we saw a nice uptick in sales. We're about 40% more sales year over year in the Central Okanagan. We also saw new listings go up, but it's been a pretty balanced inventory. We're kind of right where we would expect to be at the end of January and coming into February. So no big surprises. But what did surprise me was the rebound in single family home prices, which we saw as much as 7% rebound on the single family side. So the takeaway that I'm sharing with buyers is that the bottom of the market is in the rearview mirror, and buyers are returning to the market. And over time, we will start to see upward pressure on price again. Now, on the rental side, it's kind of a different story. There's a big amount of inventory coming through, and we've seen, the average rent has come down. It's down to $3 a square foot, or an average unit is roughly $2,000. And there's a lot of stuff, both either in the pipeline or currently under lease up, that is really adding to the vacancy rate. And so we get all of our stats from New Realty Research, and we've seen vacancy rates in some sectors of the market as high as 6.5%, which we have not seen these level of vacancy rates for a very long time. And so for the next couple of years, there's an expectation that vacancy will be probably somewhere in and around 5% as we kind of navigate and absorb all of the stuff that's coming on stream right now. You can see the total rental universe is roughly 8,000 units. There's almost 6,800 proposed. Now, most of those will not be constructed. There are currently 2,645 under construction, meaning they're chip committed at this point. They're going to be coming to market. That alone is an increase of available rental units in the Okanagan of 30%. And then we have 1,800 that are actively attempting to be leased up right now, and they are not part of the vacancy rate that you hear. So whatever amount of those 1,800 that are currently unleased is additional shadow vacancy inventory that is not reported, because when a building comes to market, they are not considered vacant until they've been through their lease up phase. So this is kind of an overview of the map, and you can see Kelowna's at 3.8, which is the highest of the Central Okanagan right now, because that is where all of the development has been concentrated. So therefore, we have a bit of an oversupply at the moment. If you look out to Vernon, you'll see it has the lowest. It's 0.7%. So we have a project in Vernon right now that we know we are going to way overperform on, and that is something we're looking at, seeing that median square footage go from $2.57 probably closer to that $3 mark, because there's such a tight inventory there in Vernon. So if you're looking at investing in rentals in the Okanagan, a good place to look right now would be in Vernon. Now, this is our rental grid. I know you can't really see it, so I'm going to have Iskander send this, put this on a link in the chat so that we can get you guys direct access to it. And then you can bookmark this website. We will always publish on our property management website the most up-to-date market rents. So when you're doing your calculations and when you're trying to analyze what a property might fetch in the rental market, you can easily look and cross-reference whatever it is. So if it's a home with an upstairs and a downstairs suite, you can see, okay, it's an average. It's a 3-bedroom up, so $2,200 for an average 3-bedroom, and I have a 2-bedroom basement suite, so $1,750. Okay, I would get $3,950 for that property, and you can base your math on that. Okay, switching back to the resale side of things, the market is either in a seller's market, a buyer's market, or a balanced market. It's very rarely in a balanced market. It's usually just in some stage of transition, moving back and forth on the pendulum. We are still very much in a buyer's market because we have 10 months worth of inventory. And you can see that steadily, kind of since the market corrected back in 2022, that our inventory has just been creeping up consistently. But where we are now is right around 10 months of inventory, which is still a buyer's market. But I suspect that as we come into the spring, you're going to see that come back down into the 4, 5, 6 range would be my guess. And so right now really is the most opportune time to negotiate. If that is something that you're wanting to do, your best negotiating position is probably in the rearview mirror, but it will progressively get less opportune as time goes on. So time is no longer serving us as buyers. On the demand side, we do have decent demand. I mean, the population growth in BC is good. Kelowna's 4.3% population increase is one of the highest in Canada. That was over a couple of years. UBC is feeling a little bit of pain with the immigration policy changes, but still student demand continues to increase. The job market has dipped for sure, but remains still one of the strongest in Canada. And so we do have pretty decent demand drivers in place at the moment. Now, of course, interest rates are one of the biggest catalysts to things changing. We had significant interest rate cuts last year and already had one this year. And the Bank of Canada is a major trigger for a market recovery. Now, we expect to see more rate decreases, especially in the face of tariffs, which will obviously improve the affordability picture for buyers that are coming in. And they've also made some policy changes that really do help affordability as well. And I believe, even though my opinion was we would have been better served with a conservative government here in BC for housing, the NDP does have some policies that incentivize construction and speed things up at the municipal level. So I do think that there are some policies that will lend itself to a recovery as well. So the big takeaway there is capital is getting cheaper again, which means we can use more appropriate leverage. And the policies that they're putting in place will be pushing us into the recovery period. Now, it's not all good news. There are sort of converging factors, right? We have certain drivers and influencers that are heating the market, and we have certain drivers and influencers that are cooling the market simultaneously. And so what's heating the market, as I mentioned, was the interest rates. We've got the population growth. We've got demographics. There's a massive transfer of wealth happening from the baby boomers down to the millennials, massive transfer of wealth that's just starting to happen. So for the next 10 years, there's something like 75 baby boomers turning 75 every second, something to that effect. I read the stat this morning. I probably butchered it, but it's a staggering number of people, and they'll be looking at legacy and continuity plans with their with their children. The media sentiment is hopefully, it certainly was, everything we saw in December and January was all very positive. Of course, the news cycle's caught up in what Trump is doing right now, but I think that we're going to see very positive media sentiment about real estate going forward from here. And of course, we have much looser lending. A lot of the banks are trying to get money on the street now, whereas before they were tightening. Now we're going to see policies that are loosening and getting more of that capital out there and into investors and buyers' hands. Now, on the other side, the job market, although I used it as a stat that is saying that the market is decent, the job market is still tough here. There's still a reasonable amount of unemployment, and there's a lot of businesses that are struggling at the moment. I mentioned the political uncertainty, the vacancy rate going up. Government policy is just a wild card. We don't know what we're going to get. And so there's a lot of that uncertainty can create, a bit of a scared money effect on the sidelines. And then even though things are becoming more affordable, they're still relatively unaffordable as compared to some of the other areas in Canada still. Now, I'm kind of a nerd and I don't expect you to absorb this whole thing. I draw the red box around this because I'm tracking every one of the drivers and the influencers of the market to see where we land. And I highlight the ones that are true. And so you can see that in the beginning of the recovery, so there's three sections of the market. You have a boom, a slump, and a recovery, and it just continues to do the same thing. There's also a beginning, middle, and an end to each of those sectors. And so right now, we're right at the beginning of a recovery, because if you track that all the way to the bottom, you can see the number 9. So there are 9 things that are true here, and that is the most. And you can see that it corresponds all the way down in a nice linear fashion. So it's pretty obvious to see where we are in the market when you just look at the data and you track each of these items. And what's really cool about the beginning of the recovery, I'll share with you in a few moments, is that it's when most of the best strategies become viable again. So the most simplistic way to look at the market is via a pendulum, right? And it moves between these fear and greed cycles. And we've been in a really deep fear cycle. And I know that with the uncertainty right now and tariffs and not really knowing what our federal government's going to look like, there's a lot of fear still in the market. But the pendulum is swinging. There's an optimism back into the market. It is moving back towards a more balanced place. And eventually the next place that it goes is back into a greed cycle, which is when, of course, property values go crazy. And that old adage that be greedy when others are fearful rings true, and then be fearful when others are greedy. So that's the time to get out. So when we look at the clock and we sort of put all the different trimesters into a clock here, we can really see where we are. We're at 7 o'clock. We're right at the beginning of a recovery. And so I've been tracking this, doing this exact clock for over a dozen years, and I've been plotting it along as we go. And we've been right and ahead of the market each time, because that scorecard I showed you, we're always tracking data to see where we plot on the map or on the clock. So what does this mean for you? Well, we're leaving the slump finally, and we're entering the recovery. Now, winners buy in a recovery, not in a boom. Now, everybody else buys in the boom, right? You have to be willing to do the uncommon thing. But the smart money is going to get deployed before the crowd realizes the shift. So we're not going to be the school of fish. We're going to be the ones that are leading the pack. Now that we've established where we are in the cycle, we have to figure out what tactics will work best in this particular market. And then how, of course, do we take advantage of this window of opportunity? So next up, we're going to talk about the playbook for this year and the years going forward. This is a tactics table. For anybody that has been part of the Real Estate Investment Network, you will recognize this. This basically breaks down the 3 tactics that are the most common, which is a simple buy and hold, simple fix and flip, and then also a rent to own. Rent to own is good because it requires a long-term mindset to make work. And so we're going to break those down. You can see that for buy and hold, the optimal time to enter would have been the end of the slump, which you could argue we are still in the end of the slump. But through the recovery period, it's good, even still possible at the beginning of a boom, but you really want to avoid it from that point onward. So we're just coming into the gravy on a buy and hold strategy. Now, if you're thinking about buying distressed properties, flips, that kind of thing, you can see that it's really only possible at the end of a slump, and then it gets optimal right at the beginning of the boom. So we have that whole kind of period where it's good through the middle and end of the recovery. So it's just setting up nicely. And then, of course, the optimal time to do a rent to own is right in that sort of mid part of the recovery. So that's still ahead of us. So we've got all of the best strategies right there on the forefront, on the horizon for us. The way to look at investing now, as we know we are in the recovery stage, is on a long-term mindset. The short-term gains are wonderful, but all of the wealth that I've created for myself and my family and for my investors over the years has been buying at the beginning of a cycle and riding it through to the end, which could be a decade, right, from where we are today. But you will never get hurt owning real estate from a time in the market like this for the next decade. In fact, you will do extremely well. That is where massive amounts of wealth are created, is just timing the market and getting the right entry point, which is right now. Now, it's not without its challenges, right? A lot of investors currently are stuck. It's difficult to finance properties still for investment. Their banks are still a little bit skittish when it comes to investors. They want people who are living in the homes. It's still hard to find cash flow. I'm going to show you an example in a moment of an existing property that cash flows today, but they do exist. The vacancy risk is something that they want, or that you're going to want to be mindful of. And the tenant-centric policy is something that does make navigating the real estate market a little bit tricky as well. There's some new rules. There's some new opportunities that come with it. So stratas can no longer restrict rental age. Now, 55 pluses can, but all of the 19 or the 45 plus, all that stuff is unrestricted now. And so that opens up new rental stock. Half duplexes previously were not allowed to have rental apartments underneath. They now can. So that opens up a new type of property that you can get cash flow with. No mutual agreement to end tenancy. That's a tough one. There's no real opportunity behind that. You can't contract your way out of the Tenancy Act. This is a real thing where getting people to leave your property requires negotiation now. You can't leverage them out using this contract. The flipping tax is new, 20% tax on the profits made by flipping. They're trying to de-incentivize short-term thinking. And then you've got a vacancy rate that is now high enough to allow short-term rentals again. So I know somebody was interested to know whether or not that was going to come back. It remains to be seen, but my guess would be yes. And I think there will be opportunity because the total short-term rental universe shrunk a ton after they enacted this. And so if it's back on, I think people will be tentative to come back in, but the people who are willing to take that risk will do quite well because they will have much less supply to contend with. So I think there will be some opportunities in short-term rentals later on this year. The biggest opportunities that I see right now are distress sales. You've got some people right at the end of the finance cycle who are over their skis. We're getting lots of calls from people who are pre-foreclosure. No, I wouldn't say lots, but we're getting more than we did a year and 2 years ago. Now, there's a thing called cap rate compression, which I'm going to break down for you more clearly on a future slide here. But what that means is that if you can buy at today's cap rates, by the nature of money getting cheaper, the investment properties, especially multifamily, the values of those properties will go up when money gets cheaper. And I'll explain why in a second. Big opportunity is building purpose-built rentals in some of these infill using the MLI Select program. So the MLI Select program is a government incentive to get builders to build more rental stock, and they are providing really nice leverage. Now, you can buy a rental property and finance it all the way up to 95% loan to value, even if it's existing and rented, provided that the rents are sufficient to debt service it. And you can get that money on 40, even 50-year amortizations at really low rates. And so that MLI Select program is a real opportunity for multifamily investors. And multifamily is anything north of 5 units. It doesn't have to be a big apartment complex. And so you could build 8, 12-unit buildings on some of these single lots that are in transit corridors in the infill. So there's some opportunity there. And then there's some new incentives for first-time buyers as well. So you or any of your children are looking to get into the market, buying something that is more of a rental property, something a little bit more expensive, close to $1.5 million even, that had multiple suites, can now be bought on 30-year amortizations using really high ratio mortgages. And there's some more incentives that they've brought out as well, where they've increased the RRSP threshold as well as created a TFSA-like savings account that people can use. So a lot of tax deferred opportunities for first-time buyers to be able to get into their first property. And I think it's a great opportunity to buy an investment property you'll keep for your whole life, not just have a subsidized living situation for the period of time that you're living there, but when you're ready to move on to a more executive house, you've got this 4-plex or 8-plex that's there for you and will provide cash flow for years to come. 2025 good ideas, buy, fix, and hold. I love the BRRRR strategy. I'm going to break that down a little bit more. Infill multifamily, as I mentioned, using that MLI Select financing plan. Rent to own is back, baby. And the tenant first option is the most most risk mitigated way to do it, the least risky. And taking a long range view of those 3, even 5-year deals can give you really safe cash flow and no headaches for a long period of time. And as I mentioned, building for those folks that are buying those first time homes, that are looking for multiple mortgage helpers as they go through it, that would be a lucrative business to enter if you were to build stuff that had multiple suites so that a first time buyer could take advantage of all the programs that exist, but live for free or on the cheap. What I would avoid this year is hanging on to older rental stock, because there's so many really nice new units coming out that are offering incentives from flat screen TVs to 2 months free rent and everything in between. If you're sitting on something that is deferred maintenance, you've been kind of a little bit slow to repair things, and you're still kind of at the top of the market and someone's locked into a lease, you can expect that when the lease renews, they're going to be looking for greener pastures. So holding on to older rental stocks, probably a tough one this year. The infill fourplexes, all that RU7 stuff, that still does not pencil out. I've seen some people get hurt on those as of late, and it doesn't seem to be any relief there. It doesn't look like building costs are coming down. If anything, they're going to go up a little bit with the tariffs. And so I don't think that those little fourplexes make any sense. And flipping the old way, the way where you buy, fix, and sell real quick and now pay a bunch of tax, is likely not going to be a great strategy for success this year. Now, I'll say too, in a down market, which we're just at the tail end of the down market, there's a window of opportunity to still do some creative stuff. So if you're real creative and you like the zero money down or no money down type deals, which I love, those are near and dear to my heart, like the vendor finance stuff, the lease options, the agreements for sale, your season for doing those deals is rapidly coming to a close. So you need to do a bunch of that in a very short amount of time, because your negotiating power when things are selling again and selling quickly, and when they're going up in value, is squashed. So you got to do this while people are still fearful, and that fear is ending quickly. But there is still the distressed sale opportunity that's happening right now. So let's talk about that a bit. What to look for. Anything with really deferred maintenance that could be ripe for a cash offer. Poor management. They've had tenants that have walked all over them. They've been really bad, ugly tenant situation. You can pick those up for a cash offer. Below market rents, and they've got high expenses now. Above market expenses, that will lead to people wanting to fire sale property. Underdeveloped parcels are great to look for as well. People with lots of equity who just want to move on and want simplicity. High vacancy can put a lot of financial pressure on people. If they've got a place that's been vacant for 3-4 months, oftentimes they'll take a cash offer. And I always look for properties that have that low-hanging fruit renovation, the stuff where you can go in there, do your floors, do your paint, and get out of there pretty quick. And of course, location. You want to always make sure that you're buying in great locations. One of the ones, a couple live deal examples right now that we're working on. There's a property on Moberly Road that's got an after renovation value of about 1.1 million. It's going to take about $100,000 to get the place right. And I put roughly, I'm using really round numbers here, but about 100,000 in soft costs. So that's, the couple percent it costs to buy it, the couple 2, 3, 4% it costs to sell it, and the 3 or 4% it costs to carry it. Add that up and in your accounting fees and that kind of thing. And you got about, a 10% soft cost, which led to us making a cash offer price of $750,000 on the property, which seems to be in the final stages of acceptance now. And we'd be closing on that in the later part of May, with an estimated net profit on this project of about $150,000. And then we'll just resell this property right away here in 2025. So that's a live deal from somebody who just wanted to hit the easy button. Another one that is currently a live deal, I'm just trying to give you guys stuff that's happening in the moment, is a property we've located on Mission Springs. They called in requesting an instant offer. We have determined it's probably worth about 1.2 based on the recent comps in the neighborhood, and it needs about $50,000 just to get it right. Again, another $100,000 in soft costs to buy, carry, and resell it. And we figure we'll net $150,000 on that one as well by offering $900,000 on the property. That one needs a quick sale, so we're mobilizing capital now for that one, and then we'll be looking to resell that in Q3 of this year. So those are some live deals. You can see there's pretty significant opportunity if you can buy stuff, at below 70% of its after renovation value. You're doing pretty good. Now, flipping houses is something that I've taught for a long time, and I'm a big proponent of it, but you have to know how to do it the right way. So there's a formula for it, okay? You must always begin with the after renovation value. Most people do this backwards. They pay whatever they can pay for the house, do their best, then they do their renovation, and then they add what they think all that aggravation was worth in terms of a profit margin, and then they add all that up, add the realtor fees on there, and then they ask for a selling price. And oftentimes that price is not realistic, which means what goes margin. And sometimes it puts people at a loss. So you really want to always start with the end in mind. Every property has a maximum dollar for after renovation value. You should be able to figure that out pretty quick between you and your real estate professional. It's something that you can arrive at pretty fast. Then you work your way backwards. A renovation, shouldn't cost more than 10% of the after reno value. It's pretty hard to make things work when you have renos that exceed that. And your buy, carry, and sell costs, those soft costs, you want to keep those below 10%. A profit margin of 10% or so is reasonable as well. So for rough and dirty math, just really simple. I mean, there's obviously way more involved spreadsheets to get these deals done right. But just in the beginning, you have to be looking, can I buy this property at 70% of what it is worth when it's done? Because if the answer to that is no, you got to keep shopping. There's just nothing there. There's no opportunity. No matter how much potential you see in the house, no matter how cute it would be when you knock the wall down, it's not going to make you any money unless you're buying it at 70% of what it's worth complete. So simple example, if it's worth $1 million at the end and it's going to cost 300 grand between all of the costs, you got to buy it at 7. Hopefully that makes sense. If you have any questions, you can throw it in the chat. That's a really simplified version. We're going to dive way deeper when we do the course, but I wanted to give you guys that just so you could do back of napkin math when you're looking at properties that might want to be flipped. Now be mindful, as I mentioned before, there's a 20% flipping tax now, but there is an exemption if you're willing to go pro, which is if you're a business and you are actually doing this professionally, you can avoid this tax. Now, of course, you're paying active income tax, which is a higher tax, which is partially why they let you do it, but you're not getting immediately penalized at 20%. And an operating business can have expenses. And so, you obviously consult your tax professional, but there's write-offs and things that an operating business can benefit from, and you are not immediately subjected to a 20% tax. Now, the ultimate workaround, in my opinion, because buying, fixing, and selling is great. Growing up, I watched my dad buy, fix, and sell, and he would make 50 grand here, 100K here, and he'd do a couple a year, and he always made good money. But what he didn't do was amass any wealth because he never kept anything. And so my strategy has been more of a buy and hold, but I still really enjoy adding value, going in there and bringing properties to their full potential, and of course, realizing that profit. But I want to keep the asset at the end of the day. I want to extract the value I create, but still keep the asset so that over time I benefit from the tenants paying it off and from the market doing what it always does, which is double every 15 to 20 years. And so I want to participate in all of it, and I want to avoid paying as much tax as possible. And so the way to do that is the BRRRR strategy. And I know many of you guys know this. I certainly did not invent it. This is taught ad nauseum in every real estate forum you could go to. But this is the section of the market now where this is the best strategy to implement, where you buy the property, ideally in distress at a nice discount. You go in, you force appreciation by way of renovating. Once it's all titled up, you bring in nice, high quality tenants. The tenant caliber you're going to get when your property's renovated is so much higher. Now they're paying, higher rents, and based on those higher rents and that higher appraisal that you'll get with the property being done, you can leverage out of it by way of a refinance and likely have all of your capital back to go and do the same thing. So there's actually another R you could add to the BRRRR strategy, which is repeat. So this is what it looks like. The little cycle, the liquidity cycle continues, right? So if a property is worth, say, $1 million, we try to buy it 15% back of that. You'd be into it for $850. Maybe you throw another 100,000 into the property to force its appreciation upward. You get it to 1.25. Then once it's worth that and tenanted, you've got the ability to refinance out 75% of that value, which would give you over 900K. And you can see you're getting almost all of that out. You're extracting all of that out by way of the additional loan, which allows you to go and take that 300,000 and repeat the cycle. So that's what the BRRRR strategy with the extra R is the repeat side. If you can execute a couple of these over the next 3 years, you're set for life, right? You only need 3 properties at this range. If you're in your 40s or 50s now, if you can acquire 3 or 4 properties while we're going through the recovery phase like this, recycle the same 300 grand 3 times over the next 3 years, by the time we reach the top of the cycle, 6-7 years from now, your equity component is going to be huge. The value of the property, your cash flow, all of it there, your retirement will be made by these 3 properties that you acquire over the next little while. So I love the BRRRR strategy, and I think that I'm going to use it in my personal portfolio very aggressively going forward. Now, I do it in multifamily. I did a lot of residential over the years, and now I like the multifamily because you get economies of scale, and I like to do it at a larger scale now. But you can do the very same thing. You can rehab the units, raise the rents, refinance, get your money out, repeat the process. Here's an example of one that I did on Hush Road with a partner, and we went in there, bought it in distress, and we doubled the value of this property over the course of a couple of years, pulled out all of our cash, and went and did some more damage in the market. Now, here's what's really cool about investment property, particularly the higher value ones, because as cap rates compress, I was talking about one of the opportunities right now is cap rate compression, values naturally increase. And so what I mean by that is, let's say your building creates $100,000 a year of net operating income, just for super round numbers. If the current cap rate is 6, meaning investors are buying things at a 6 cap rate, and the reason they need the 6 is because interest rates have been 5 or so percent. So there needs to be more than the interest rate to make any money. So if the value, meaning for 100 grand worth of income, investors currently are willing to pay 1.66 million. Now, if rates come down by a percentage, you'll find that investors are now chasing investment properties at a 5 cap value. That same stream of income of 100K is now worth $2 million. If interest rates come down to where they were only a couple of years ago, now we start to see things being sold and traded at a 4 cap value, which means that same 100,000 is now worth $2.5 million. Now the same thing goes, you can see that's 25x of the money. Now you can imagine that if in that same period of time that interest rates were coming down, if you were to improve the net operating income, either from rents going up or expenses going down, you would get a 25-to-1 return on every dollar you add to the net operating income, which is insane. And so that's where you get these huge economies of scale. And that's why people get so wealthy in multifamily investing. And entering multifamily when you have high cap rates is the best time to do it. And we have not seen cap rates at 6. I was just talking with a gentleman in our market yesterday, and he was saying, investors right now, when they're buying multifamily, they need to feel real pain unless they're gonna move. And he's got multiple projects that are for sale right now at 5.5 caps, and there's no takers because money's expensive. There's fear in the market, and so things are trading at 6 caps. And so if you can buy something right now at a 6 and ride through the next phase of the market and exit or ideally refinance at the 4 cap valuation, you're gonna make a lot of money, tax-free. Now, I mentioned that MLI Select program. I really believe it is the opportunity of our generation, being able to leverage these massive assets at 90% loan to value, even 85, some of them up to 95% loan to value, depending on how much rent they bring in. It's a huge opportunity. And it's something that the Liberal government put in place that I think will probably disappear in the not too distant future. And so I think we're going to want to jump on this while the getting is good. I have $100 million worth of this type of stuff in the queue to be developed right now. I'm going to play this little video for you guys just to kind of give you, some of you have seen it, but I want to play it anyway for those of you that haven't. Actually, you know what? In the interest of time, I want to leave time for Q&A. I'm going to skip it because it's 5 minutes. Check it out on YouTube. It's a $100 million multi-unit investment. Check it out on my personal YouTube or on the Vantage West one if you want to watch it. Okay, switching gears to rent to own. Now, rent to own has a bit of a stigma. A lot of people don't really understand it, nor do they care to. Most realtors would tell you it's a total waste of time. I have made an enormous amount of money with rent to own, both acquiring properties this way and managing, like carrying properties this way and disposing of real estate this way at a profit. It has been very, very good to me and to my investor partners over the years. Now, if you look at the tactics table, you can see the optimal time to execute a rent to own strategy is the middle of a recovery. So we're right almost there. Like in a few months, it's going to be the optimal period to execute this strategy. So I am gearing up to do this at scale. What I like about it is you're bringing tenants in that are going to increase your cash flow, but decrease your risk. You'll get a non-refundable deposit, always $20,000 or more, which is some pretty significant skin in the game for a tenant. You no longer deal with maintenance expenses because they sign a contract that says that they will care for the home like a diligent property owner would. You're getting higher monthly rent payments because the payment is both the rent and their equity buildup. So the two combine for a very nice payment, and you get to spend all of it because you're only crediting them back the equity when they buy. You have not no vacancy risk, but as close to that as you're going to get because, again, the skin in the game, right? They've bought the house. A lot of times they go and they invest their own money in making the house nicer. So on top of the deposit, they also have their own blood, sweat, and tears in the house. And of course, you remain on title the whole time. So it's way better than private lending where you have to foreclose on someone if things go wrong. You don't have to foreclose to get the title back. It remains in your name the whole time. So I love this strategy as the owner. I also like acquiring properties this way. It's the best mitigation tactic because if the market does turn down, which going forward it won't, but if you were still worried about that, you have a tenant buyer who is your deal partner that will ride out the storm. They don't want to see the deal, collapse. So you just agree to extend and hang on for brighter days. They also are willing to share in the downside risk with you on the property. So nice thing is you're in control. You control the sale price, not the buyer, and you get to protect the margin. So you get to determine what your exit price will be and over what period of time and make sure that it all calibrates to the return on investment you're looking for. And as long as it's fair, you strike a balance in fairness, but it's a really nice hands-off way to buy and exit a property years later. So who do we target for these types of deals? Foreign buyers are a big one for sure. They come usually with cash, but they need time to get their landed immigrancy and get their worlds in order. People who are business for self who haven't filed all their taxes yet. You've got divorce situations, just not ready to put stuff in their name just yet. New or rebuilding credit. People who are waiting on a home to sell somewhere else. They move to an area, they do a rent to own while they wait for their house to sell. And then just tenants. We have tenants over at Property Management who use this program as a stepping stone to get a foothold in the market. So what I really like about it, of course, is the better cash flow because cash flow is king. I love the fact that the ROI is predetermined. So it takes a lot of the guesswork and the risk out of it. No management. You don't need a property manager for it. You don't need to do anything. It literally manages itself because they're on the hook for all the maintenance and they don't miss payments because if they do, they lose their deposit. So you really have no trouble there. And it takes less cash to acquire one of these properties, which I'll explain a little bit more in a second. And of course, the reduced vacancy risk is much better. And you're also helping people. I like helping people break the cycle of paying their landlord's mortgage. I love when we can, make a win-win deal. What's tough about rent to own, it's got a really bad reputation. So sometimes the birds will get to your people where they'll go, "You're thinking of a rent to own? Why would you do that? It's terrible." The reason why is it's an unregulated wild, wild west. And every late night infomercial course that was telling people how to buy property with no money down was turning people into rent to own or lease option wholesalers. I don't know if you guys saw on Crime Stoppers just recently, there's a gentleman on Crime Stoppers. He was executing this strategy, but in a fully unregulated way and in a really nefarious way. It does attract some major losers into the game. So that is one of the things I don't love about it. I don't like being adjacent to those type of folks. But when done well, this is an extremely good strategy for all involved. And but the buyers can be a little bit flakier and they will often play the victim card if it doesn't go well. So you have to be mindful of that. And it can be really litigious if it goes wrong. So as a brokerage, how we've addressed that is we've created a really dialed in process and we have a marketing machine that increases our options for tenants. So we pick only the cream of the crop. And we also insert clauses that take the teeth out of the contract a bit, where we have extensions at the end of the term. If they can't get their stuff together, we'll extend for a year and then we can either sell the property or find someone to take over and usually get them their deposit back and prevent all that heartbreak that will come with it and the bad press that could come. So we really get ahead of the problems and it's worked really, really well. The brokerage aspect really helps though. Being in a licensed brokerage that is, we have the trust account to manage the deposit. We've got our whole finance and legal team to do the hand holding for our tenants. Obviously, we can list the properties on the MLS, which gives the banks comfort. And then, our marketing and our inside sales team can increase our options to really, reduce the risk. So it helps to do this through a brokerage. If you want to do it on your own, fly at it. But through a brokerage is by far the safest way to do it. And then you defer all the liability and pass all the liability on to us. Now, what's cool about rent to own is it can go in one of two ways. There's two ways. There's tenant first rent to own and there's property first rent to own. So if we have a property that's available on rent to own, we'll advertise that property and we'll get all kinds of applicants. You got to kiss a lot of frogs to find the prince. Most of them have no money. The ones that have 5% down would qualify for whatever inventory we have. Now some, and it's like 1 in 20, have a pretty sizable down payment. These are the people coming in from out of country, or resource workers that have got lots of income but are business for self suddenly. They've got lots of cash. They're putting $100,000, $200,000 down sometimes. And so we empower them to actually pick any property they want on the MLS. And so that's called our Empowered program, where if they've got 10% or more to put down, they can choose any property on the MLS they want. We go and negotiate the best possible deal we can as a cash buyer for them. And then we tailor the rent-own agreement to meet their needs, but to give us the return on investment that we want. And so great returns, much lower risk. Megan, your question, so doing with the brokerage is a done with you strategy. Correct. And we also do it inside of our fund. So you can, the done with you and the done for you options will give you exposure to this strategy for sure. Here's an example of one that we did. The lease option matured in June. We put the tenant buyer put $130,000 down, and we ended up selling it to them for 1.485, made a 24% return on the investment over that period of time. Total hands-off armchair investment. Another one on Providence, very similar, $110,000 deposit they had. So what that does is it reduces the amount of cash we have to put into the deal. So to buy a property for $600,000 in this case, the deposit was almost entirely covered. The down payment was almost entirely covered by the deposit that these guys had. So we had almost no money in the deal. So it was a very, very good return. Before we go any further, you guys enjoying this? Is this good? Am I going too fast? I'm trying to cover a lot in a short amount of time. How is this, guys? Let me know. Throw me a little message in the chat. I appreciate you guys being so interactive. I'm sorry if I'm talking too fast. I'm just watching the clock and seeing the minutes tick away. All right, let's keep rolling. Okay, so here at Vantage, and we don't see a deal every single week because we don't want to give you guys any bullshit. We only want to give you stuff that's really vetted and truly exceptional. But I am curating as well as, I've got 15 super talented agents that are out there seeing properties every single day. And we're curating what we believe are the best opportunities. We talk about it in our meetings on Tuesdays and Thursdays. So the current example of our deal of the week right now, just to give you an idea of what is currently possible just on the MLS, there are not many of these. This is I had to turn over a lot of stones. But here's a property that's been on the market for less than a week. It's listed at $899. It is renovated actually really nicely. And they've got 6 bedrooms. So you've got a 4-bedroom main house and you've got a 2-bedroom legal suite in this property. So a legal suite, this property would have been $1.2 million at the peak of the market and would not have penciled out. Now it works. Here's the math on it. You can get $4,700 a month. It'll cash flow even at sort of higher interest rates, at least $500 a month. And that allows for you to have contingency reserves and all that stuff. So price at $899, you could probably negotiate that down somewhat from there. But even if you paid full rip, you've got over $500 a month. Now, what's nice is interest rates have come down enough too that as you're making the payments on this property, as the mortgage is $3,300 a month, you've got $1,400, $1,500, even $1,600 a month now of principal reduction. When interest rates are 5 or 6, one of the ugly parts about it as investors was that we're only seeing like $300 or $400 a month in principal reduction in those first 5 or 6 years. So real estate holding should be like a 3-course meal, right? You get the appetizer, which is the cash flow. You get the long-term appreciation, which is the dessert. But the main course is the mortgage pay down. And so when you're not getting the mortgage pay down, it's kind of a little bit underwhelming in terms of the gains you're making. But now we're back into the space where you can get interest rates at 4% again, in which case your equity pay down, which is all coming from the tenant, is substantial. You'll be picking up 18 to 25 grand a year on a property like this of mortgage pay down. And then of course, as things return and we get back to peak pricing, you're going to pick up another $250,000 in appreciation, just returning back to the 2022 highs. So pretty cool opportunity that's just out there and live for the taking. So we have a deal of the week list. If you're interested in being part of it, some of you already are, and I appreciate you for that. sign up here and we will get you on the list, and I will plug you into our deal of the week system. And we just send them out there. It's a jump ball. A lot of people just like to do it for education. They just like to see what I think is a good deal. And some people have their finger on the button and really do buy, and we do deals from sending out these emails as well. So that is the point of it. But yeah, it's a good way. Either way, it's free, no obligation to do anything. Sign up for it. I'll leave it up just for another second or so. It's also in the chat. You can see Iskander's put it in the chat, so it is there for you. And look, everybody that was on this call has hung around the whole time, so I must be doing okay. And I appreciate all the kind words, guys. Thank you for all the encouragement in the chat. So if you're liking this kind of content and you want to keep rolling, then this offer I've got for you for this event, I think, is for you. So we're going to do this on the 25th of April. It is an in-person room. I love Zoom. I mean, I love we're on, what are we on, StreamYard? And all this virtual meeting is cool, but nothing replaces being in the same room, shaking hands, shoulder to shoulder, and meeting the awesome people that you're going to meet. So be in the room with a bunch of serious investors, deal makers. We're going to put deals together there on the spot. I'm going to teach some really advanced strategies. I'll have the opportunity to go a little deeper because we'll have more time. And I'll be building upon the information I'm sharing tonight. And then there's going to be some really exclusive insights that you're going to hear from other experts as well. So not just me, the talking head. And you'll make some awesome connections that will really supercharge your investing game. So that's the 25th. Now, special offer for all of you guys for coming to my workshop here today. I want to extend that VIP pack upgrade that we had in the beginning, which was the deal analysis worksheet, which is worth about $100. The investor course, which I'm going to start at $1,000 and take it up from there. The book, signed copy of the advanced copy of the book at $47, and the lifetime access to the recording on this. Plus, you get an exclusive ticket to that event as well. So that $197 was what it cost to upgrade to the VIP. Many of you guys did, and I really appreciate you doing that. So I will see you there because you already have your tickets. But I really would love to see some more of you guys take advantage of that offer so that I can see you at the event and also see you in our course, because I think that course is going to be exceptional. I've been planning it now for the better part of 3 years, and I'm ready to roll it out. And I think you guys are going to be really impressed with the quality of the content and the coaching. What's cool about it is it's going to be an opportunity for us to chat over Zoom and sometimes in person so that we can solve your problems real time. It's like having, an investment coach as you're doing deals. If you want somebody to have a second set of eyes on it, or if you want negotiation help, and whether you're using us or you have a different realtor, it doesn't matter to me. Now, anybody who utilizes us will get all of their money back for anything they invest in our educational products, rebated to them whenever they buy or use our property management. So the special offer to upgrade to that is $197 USD. Now, don't yell at me for doing it in US dollars. I apologize, but I live 4 months of the year in the United States and I need US cash. So I made the decision that all of my education stuff will be charged in USD. So rather than charge you $250 or $260 Canadian, I'm just charging $197 in USD. It looks like a smaller number. And I know everybody's anti-American right now. So I was concerned about the USD, but I need US cash when I go down there so I don't get killed. So that's why, selfishly, I charge in USD, but I lower the price to accommodate it. So if that's cool with you guys, I think it's a ton of value for $197 to get access to an event, to be first through a course. I mean, it's over $2,000 worth of value for $200. So I wanted to extend that to you guys for showing up here tonight. And if you upgrade tonight before, we're actually going to discount even further to $149. So hopefully you guys do that. And here is the QR code to do that. We're going to get back into the content here in a second. I just wanted to plug that before anybody skedaddled at 6. So there's the QR code. I'll leave it up for like another, 10 or so seconds. So if you want to upgrade, snap a photo of that. There's also a link in the chat that Iskander was kind enough to throw in. So if you want to upgrade, I'd love to welcome you there. And obviously the VIPs that upgrade are going to be the ones on the bus when we do our ugly house tour as well. That's just an automatic. So to sweeten it, hopefully we'll see you guys there. All right, let's keep rolling. Oh yeah, I forgot to mention, if you make the investment of the $170, whatever that is, or $250 after the conversion, I will give you 120%. I'll give you a 20% return on that investment if you use any of our companies, whether you invest capital in our fund or you buy a property through us, sell a property through us, use us for property management, anything. I'll give you full credit plus 20% for any investment you made. So trying to make it a no-brainer for you. Okay, I want to talk about partnerships for a second. Partnerships for me was the big unlock to financial freedom. That's how the bulk of the wealth I've created in real estate was via a partnership. And I think a lot of you guys would benefit from understanding how to structure these partnerships better. Now, I've been doing partnerships for 20 years and I've learned many, many lessons along the way. I can tell you what worked. I can tell you what didn't. I've made every mistake in the book, and hopefully I've paid those tuitions so that you don't have to. Little picture of me and one of my early partners. This is back in 2003. This was a project that we bought this 2 acres of beautiful land over West Kelowna, and then we got absolutely crushed. Our dreams were crushed on this one. This was a big mistake. And we had none of we were buddies, and we just jumped into bed together, and we had none of the things that would protect ourselves in a partnership that I'm going to share with you here in a second. And it was damaging for our relationship for a period of time. We're thick as thieves again, but there was about 5 years where, we weren't chatting too much to each other. And I think it created a lot of tension because we didn't set it up correctly. So I'm going to show you a little bit about how to do it. Number one, always have a buy-sell agreement. I don't care how good your relationship is. You need to have a structured buy-sell, or better known as a shotgun clause, in all joint venture agreements. I will never enter one again without this agreement. And you also want to be really careful to pick complementary partners, okay? Just because you guys like having beers together doesn't mean you're going to make great partners. I'll show you how the different pieces of the puzzle intertwine in a second. And then you want to make sure you have a clear exit strategy. Making sure you both have the same time horizon for the partnership or for the specific investment is really clear. Because if you do this the wrong way and one person wants to be in and out and the other person thinks they're holding on forever and you don't have a buy-sell agreement, lots of friction can take place. Now, a partnership's got to have one of these 3 things. Your partner needs to complete this. For every deal, there needs to be money, there needs to be time and energy, and there needs to be expertise. Most people do not have all 3. If you've got lots of money and lots of expertise, usually you don't have much time. And if you've got lots of time and energy and usually you don't have much money at that point, right? That's just kind of the nature of the beast. So you want to combine and join forces because you actually need all 3 to do this successfully. So you want to fill the gaps by get the partners that provide what you lack. And it's your partner's clear contribution that brings their value. So it has to be clear. You want to make sure that when you get into a partnership, both people know what they bring to the table, and there's a value that you can attach to each of these items as well. And I'll show you that in a second. This is from RAIN as well. The Real Estate Investment Network has been teaching the joint venture quadrant for years. And you'll see that the largest amount of value is placed on capital. Okay, cash is king. It's nice to be the one with the cash. You get 50% of a deal for doing little else other than bringing the cash. You don't have to do any of the running around, vetting tenants, finding deals, sourcing, nothing. 50% of all upside can be achieved just by having money. Now, most people there's a lot more people that have the ability to go out and find deals and are reasonably expert in the field than there are people with cash. And so therefore, these partnerships are easy to find. So one party could do all of the financing, all of the deal finding, and be the captain managing the whole deal and lend all of their expertise, their time, their energy. They could lend all of that to the deal in exchange for half of it. And the other person could lend all of the cash in exchange for half. Now, you can carve it up, right? You could, if you're going to put in 50% of the cash and you're going to be jointly on the mortgage, then you'd be looking at 35% each for that. And then now, are you dividing the duties? Usually that deal finder investment manager is the same person. So that other 30% would usually be added to that. So it would be a 2/3, 1/3. If the deal captain is captaining the ship, and I made the mistake of giving my services away far too cheap back in the day. I would meet my previous partners halfway on the investment and then do all the work and only get half. It doesn't make sense. You got to get 2/3 of the deal when you're doing that. Now, if you like the idea of getting 2/3 of the deal, but maybe you're scared of doing all the work in exchange for that, there is a way to get 2/3 of the upside of a deal and do none of the work. And that would be to hitch your wagon to somebody who does this for a living in a scaled and professional way. So that is what I want to share with you now, which is the opportunity to partner with myself and a good chunk of people on this call and do some real good and some real damage in the market over this next period of time. So I'm going to share with you the strategy that we use inside of Cash Offer Canada. Now, everything I've talked about tonight, the buy, fix, hold, the BRRRR, the rent to own, the multifamily stuff, all of these things are right out of the playbook of Cash Offer. So I'm sharing with you exactly what it is that we do to create margin right now and to create as much return as we can for our investors. Those are all things you can go out and do on your own, or you can benefit from a diversified portfolio of properties and be hands-off and let myself and my team execute, and you take 2/3 of the upside, which I think is a pretty sweet deal. I believe that what we're doing is the perfect strategy for uncertain times. I built this in 2018 when they put all those new changes in place, and I really thought the market was about to head into a downturn. Of course, I didn't predict COVID and all the money printing and everything that sent assets through the roof in the corresponding years. But in 2018, we set it up. And since then, since 2019, we have been executing these strategies and bringing our investors a great return. We leverage the entire ecosystem to be able to do this. So Cash Offer LP is leveraged by the entire Vantage group of companies. So our property management, the sales division, we've got the coaching arm as well, which I'll explain how that benefits Cash Offer LP here in a second. Our home services and renovations department, everything is under one roof. So it's a one-stop shop that we leverage to give Cash Offer LP a competitive advantage here in the Okanagan and across Canada. What's cool is we've got multiple ways to make cash. Of course, we love the cash flow from rents. That's been the bread and butter forever. We love when the property values go up, of course, and renovating for profit is an absolute expertise and specialty of mine. And we love collecting option fees from rent-to-own deals because they're instant cash, as well as you've got great cash flow on those deals as time goes on. We've recently added 2 new revenue sources called assurance fees and referral fees. I'm going to break those down for you in a second. So all of the returns we've had historically that have been in the high teens are about to get supercharged by these 2 additional revenue sources. So how it works is we advertise out there in the market, and you may see these ads because we're spending a lot of money suddenly on these ads, which is just a real simple hook. Sell your home stress-free, or skip the hassle of listing your home, sell direct to Cash Offer Canada. So when somebody comes to the website to request a cash offer, there's a workflow that happens. And here's how we generate these additional fees. So I know you can't really read this, but I'll kind of go down the workflow for you. So an inbound lead comes in, we take that lead and we dispatch that to the real estate agent who's boots on the ground. So if it's here in Kelowna, it goes to a Vantage agent. If it's in Calgary, it goes to a lovely gal by the name of Erin Reeves. If it's in Winnipeg, it goes to Brad Elias. We've got people across Canada now to take these leads. And so they then go to the property and bring a cash offer to that seller. Now the seller has 3 options. Option A, they can accept the cash offer. And if they do, wonderful. We'll buy it, renovate it, resell it, and make some money. The other option would be that they use our offer as plan B and they list the property on the market for 90 days and use us as a backup plan. Well, 99 times out of 100, it's just going to sell because our offers are 15 to 20% below market value. So you know the house is going to sell for more than that. Now, in that period of time, that realtor has made some money. They owe us a referral fee, a 35% referral fee for the introduction to that seller. Option 3 is that they list the property, but they don't use our cash offer, backup offer, and in which case they still owe a referral fee. So we're monetizing the exchange in options A, B, and C. There's an additional fee called an assurance fee. If they take option B, meaning we're guaranteeing the sale of their home, we're charging an additional 1% on the sale price for providing that assurance. And so we've essentially created a system where we can be paid for our willingness to buy property, not just buying them and selling them, but just our willingness to backstop the listing gives us those 1% fees. And so we're already seeing those fees start to come in, particularly here in our brokerage this year. We've done a number of them so far, and we're going to really scale it with advertising going forward. What's cool is we can advertise infinitely when I explain how this works. So if we're generating 35% referral fees for the people who end up doing business with our either local realtor or our realtors abroad, we're going to generate close to $4,000 per referral fee. Now, what we've found is that we can acquire a seller who does business with either us or somebody in our network for roughly about $700 in ad spend. What that means is that we get a 4-to-1 return on our ad spend, meaning it's like an infinite money glitch. We can spend as much money as we want, and we're going to make 4-to-1 on every dollar spent because our cost to fulfill this, because those agents don't cost us anything. In fact, they pay us. So we have a sales force across Canada that pays us for the opportunity to deal with the cash offer leads. This is a huge profit center, and I really believe this is truly where the biggest opportunity for cash offer is going forward over the next decade. What's cool too is having this network, and that's where my coaching company is super valuable because I'm coaching agents across Canada how to build their real estate business and develop. And then we introduce to only the select ones the seller options and the cash offer program. And we say, okay, we like working with you. We know you're a really high caliber agent. We can see that you do a good job. We're now willing to open up this and license this type of business to you. And so we've got now boots on the ground that are doing all of our market analysis for us and going out and seeing the properties for us and touching them for free. We get access to their local network because great realtors often have good contractors, good home inspectors, good appraisers. So we get their network tapped into. We're getting referral fees on all the no's, the people who don't want the offers. We're getting the deal flow from the people who have the highest motivations, those that are really truly that want to sell. We're getting deal flow from that. And then coming soon, we're going to charge a licensing fee for access to these programs. Mike Dorsal, who in their right mind would accept 20% discount on their property to sell, and how many properties have you actually done? We have done dozens, and the limitation is not people who would be willing to accept. The limitation that I have is capital. I could do deals all day long, people who would be willing to take a 15 to 20% haircut on their home. It is all kinds of different things. Usually one of the big D's. Some of these houses are disgusting when you go into them. I won't sugarcoat it, but we bring a team through. If they have to wear a hazmat suit for a couple of days while we get these things cleaned up, so be it. But people who are, we have hoarding situations, properties that can't go to market, drug situations, people who are facing foreclosure, people with tenants that won't leave. It's always some distress. It's not a regular person, but there's also, I shouldn't say that. Sometimes we get regular people. We had a good one last year where the folks just wanted to move to Mexico and they didn't want to be here anymore. And the market was slow. And they had a property in Mexico that they were trying to build and they needed money and they didn't really care because they had done well on their place and they still had enough to carry on and they sold it and off they went. Good for them. So there are people who will do it, Mike, to answer your question. So the market corrected about 18% off peak. That 2022 to 2025, we saw a correction of about 18%. Prices have now stabilized, even started to uptick, and we're still looking to buy stuff at 15% below that. So in our fund, we do not buy anything unless we're buying it 15% back of what it's worth today. So it's a really nice margin of safety, which gives us exceptional returns. But we've got the message out there, a large volume of ads going out there, and we're going to be starting a direct mail campaign as well pretty soon to really increase our options. So we're going to have far more opportunity than we will ever have capital. And I'm not worried about people being willing to take our offers. That's not the issue. So I showed you guys the Moberly one that I told you about. That is one that came through cash offer. So just to recap, we're looking at making 150 grand on that one, very conservatively. Same thing with the Mission Springs one. If that all comes together, which I suspect it will, it's all happening in real time. We'll make another 150K on that and close on those this year. So those are two that are in the queue right now. And we are actively raising money to make sure we can come through on these deals. So, my slide deck's not working anymore. Where's my questions? It's a maximum of 100 on this. I had like 110 slides. Okay, well, we're almost towards the end anyway. I will let you guys start asking me questions now. I went about 10 minutes long, so your turn. Over to you. Ask me any questions, any burning questions that you have. If one of the slides that was on there though, and maybe Iskander, if you're still there, throw the link to book a meeting with me. If you're interested in learning more about this cash offer program and you want to potentially partner with us, there's a link that we can give you where you can book a call in like a 15, 20-minute call with me right in my schedule, and we can chat more about it and see if it is the right thing for you. It's for accredited investors only, so you got to be accredited, and the minimum buy-in is 100K. But up until this point, it's been lower. We're raising it to 100K now to get in, and we'd love to have you there if you've got that kind of cash and you're accredited. We'd love to welcome you aboard in the partnership. But as I said, it's time for some questions. A little opportunity for you to be coached, whatever you need. Iskander threw it in the chat. You can see it's the Calendly link in the chat. Grab it, paste it into your browser and use it in a minute when you have a chance to book a time with me. I'd love to connect with you. Good questions. I'll hang around for another 15, 20 minutes and just answer questions. Make sure you guys got what you came for. Pretty much all of you stuck around to the end, which I'm really impressed. I only lost 5 people from the beginning. So I'll take that as a win. I hope you guys got tons of value out of the meat and potatoes. I'm going to go way deeper at the event, like way deeper. It's as much as a guy can cover in an hour. But hopefully you guys are inspired about where we're going in the market. I certainly am. I'm stoked to go through this again. I've been through 3 of these already since I started in 2002. And yeah, I'm really excited to watch the cycle repeat itself. And it's going to be fun. It's going to be really fun. We're going to make some money. So hopefully you'll join us for that. Paul, given Kelowna's evolving real estate landscape and due to interest rates, tariffs, etc., what investment approach should real estate investors adopt for the next 3 to 5 years? Well, I think the BRRRR strategy for sure. I think that if you are buying stuff at a nice margin of safety, you're going in there and forcing appreciation. And if you're buying it where the rents, conservatively can give you a positive cash flow, like the example that I showed you on Graph Road for, that one, $8.99, for example, something like that, you're not going to get hurt on. Doesn't matter what the tariffs do. Interest rates are only going to benefit you going forward. They're not going to hurt you. So I wouldn't be worried about interest rates at this point. Tariffs, it's going to hurt the economy in general. I don't think it's going to create as much inflation as you guys think. Anecdotally, I'm building some projects right now, and I went to my GC, the construction manager, and said, "Oh boy, what is this going to do to our pro forma?" And we went through the whole budget, and he's like, "You know what? Pretty much nothing that you're buying is procured from the United States. We're not building a steel building. It's all BC sourced lumber, and there's really just not much in terms of goods that are going into it. You can find Canadian glass. You can buy it still from China. Doesn't the China pipeline for cheap goods will still be open to us, and I don't know. I just don't see it's that big of a factor. The biggest concern for housing would be increased building costs, and it's a bit of a scare tactic. I mean, there's Canadian source lumber. Just buy Canadian source lumber." Megan, glad to hear you're inspired. Look forward to seeing you out in the field doing some business. And Christine, if we just want to attend the event, what would that cost? We do that. It'll be $97 for a ticket. I'm hurt that you wouldn't spend the extra $97 to go through the pilot program of my new course. That hurts me right here, Christine. But yes, you can definitely buy a ticket for just $97. The course is going to be a home run, guys. I'm really excited to do the course, and ability to basically get access to the course for less than $100 because we've got other things in there with the book and the recording and all, and the tool. But yeah, to go through that course, which is easily $1,000 US value, I think you'll see at least a 10x return on that. Working with a coach already, well, awesome, that's cool. Scan the QR to upgrade on that if you want to. That'd be awesome. Paul, if GDP is impacted with tariffs, it may impact the overall market. Yeah, totally. GDP, that's what I said, it will affect the economy in some way. And so that could lead to demand destruction for sure. Kelowna is unique, I suppose, in the sense that it's such a destination point that sometimes it's impervious to GDP shifts, but not completely. If GDP is destroyed, the corresponding thing that's going to offset that, though, in my opinion, Paul, is that we're going to be seeing all the natural gas pipeline stuff all fired up again. There was reports today that the Premier of Saskatchewan was saying that anything east and west pipeline wise is automatically approved. I think you're going to see Keystone XL going again here pretty soon. I think you're going to see mining going. A conservative government's going to they're going to go hard when it comes to the resources and try to make Canada a superpower again. And so I think that the GDP from that will far exceed the loss in GDP from tariffs. Right on, though. Good question. Good debate. Keyspire member. Yeah, sweet. So Scott McGilvery too. Still got 30 of you guys here. I think they're all waiting to see if anybody asks a good question. Jessica, rent to own, does it work for condos? If you ask, would it work for 50 or 55 plus? Tricky, I'll tell you, it's a little trickier. Would it work? Yes. The chances of you finding a person who's over 55 who wants to do a rent to own are slim, though. Usually these people are a little more set up. And if they're over 55 and they don't own a home, then they're probably never going to own a home. Is my thought. So it's tough to find the right tenant buyer profile for something in that space. You're out of here, Shane. Good to see you, buddy. We will help you get that place sold. Sounds good. Thanks, Darcy. Appreciate you mentioning that. Yeah, it does work, Jessica, with condos. Absolutely. We have found that it tends to work better with single family homes, but we've done deals in condos and townhouses as well. Is there a reason specifically why you want to focus on that? Is it just price point? Best age range for rent-own clients. We've had really good success with people in their 30s and 40s, just because usually they're established, but some life event has led to them needing to do this, but they're not, they're not just getting started in the market. It works with young folks as well, but I find like the most success has been in the people who are a little more established in the 30s and 40s. Cool, good. Did I miss any other questions? I'm just looking through the chat, seeing what else I may have missed. Okay, yeah. So if someone has that much cash, why don't they just buy instead of doing rento? That's a good question. And Christine, you were correct. They not being able to qualify for the mortgage is the number one reason. As I mentioned, some people just don't want to put stuff in their name, divorce situations, that kind of stuff. And some folks, they just have to file their taxes. They got to get caught up, right? And that's another reason, which comes back to qualifying. Some people are waiting for their PR, or their landed immigrancy. So there's a few reasons why people would do that. Good. Fire on some more questions here. Otherwise, I can let everybody carry on for dinner. I really do appreciate you guys lending me your attention this late into the evening, and looking forward to seeing you guys in April for the event if you choose to come. I think it'll be awesome to see you guys there and properly rub shoulders with you. Oh, we got another question, Brent. Do I anticipate an uptick in foreclosures with the higher rate mortgage renewals? Well, thankfully, Brent, the rates have come down now to the degree that the massive mortgage or interest rate shock is not going to hit the new people coming. So the worst of it, whatever it was going to be, like whatever the worst of it would have been when people had to reset at like 6%, right? If you were in a 199 or a 225 and now all of a sudden you have to reset at 6, that's like maximum pain. But if you were in one of those mortgages at 2 and now you're resetting at 3.8, could it hurt? Yeah. Could some people go into foreclosure over it? Sure. But the max pain would have been before, and we didn't see that much. We didn't see a big glut. Never at any point did we ever have more than a dozen foreclosures in our local market, to give you perspective. Now, back in the day, 2009, 10, 11, I had hundreds of foreclosures to look through at all times. So we're nowhere close to that. Oh, Jared, Ali, your questions weren't coming through earlier, but I still don't see them. Where are they now? Jared, send me your questions, brother. Do you have any thoughts on pre-con condos trouble closing? Yeah, definitely. I do. Pre-construction stuff, there's people who are underwater. The big cities is where the big opportunity is, like Toronto and Vancouver. There's so much of it, and there's so many people that bought 3 or 4 of them that are way over their skis, that the biggest arbitrage is going to be on those. But then even if you buy them at a discount, the problem with these markets is that they were selling pre-con at 30 or 40% more than where the resale market was. And so if your intent was to buy it and resell it, you now have to contend with all the resales that are actually still cheaper than what you're getting, even though you're getting it for 20% off. So it's still a tough sled, because then you got to pay to sell it and all that stuff. So the chances of you buying a pre-con unit, even at the discount, even if someone's going to walk away from their deposit and then buy it, carry it for a bit and resell it and pay to resell it and make any money, I'd say are pretty low. Megan, is there an opportunity to have you advise how best to free up $100,000 out of the portfolio if we're in a accredited position? Yeah, absolutely. Best thing to do is connect with one of our mortgage professionals. We have 3 awesome investor-focused mortgage brokers in our network that we can connect you with. Just reach out to me offline. An accredited investor, Brent, is someone with $300,000 between you and your spouse of household income, somebody with over $1 million of investable assets outside of your primary residence, or somebody with a combined net worth between their primary residence and investable assets of, I think, north of 3 million. So 300K is usually the easiest threshold to jump, but the $1 million in investable assets tends to be the second easiest. So that's an accredited investor. Because we're a limited partnership and we operate under what's called the private issuers exemption, we can only do business and partner with people who are either friends, family members, close business associates, or accredited investors. And so for that reason, unless you fit one of the other three exemptions, then you would need to be accredited. Michael Verboff, I haven't seen you in a while. Good to see you, pal. Thanks for joining us. Nice to see some names, some familiar names. That's awesome. Well, there's still a couple dozen of you guys hanging around, so I imagine that, Sammy's 200 grand a year as an individual for over 2 years. That also works. Oh, there is one other exemption as well for accreditation. If you have a 2-year-old company and you want to invest from that company over 150K, then you are also considered accredited. The whole thing with accreditation is because private issuers exemption is totally unregulated, they only want people with at least a certain level of sophistication or a certain level of trust and relationship with the issuer, who is myself, to do business. So it's just a way for them to regulate an unregulated space. Jared, how do payouts in the LP work for tax purposes? So because it's a limited partnership, it's a flow through. So it is in the most tax advantaged way possible, which is nice. And you have lots of options when it comes to how you classify those distributions. We're also looking at, right now, it's probably a little early to say this, but we're also looking at converting what we are to a mutual fund trust, which gives further tax advantages and allows us to have a little more maneuverability as well with what we're doing. We are TFSA and RRSP eligible as well. So if you have RSPs or TFSAs that you want to put to work in real estate, we can do that. What's cool about it is I have arranged all the financing. And so I've got a massive multi-million-dollar line of credit. So we can marry the investor capital with that credit and get a nice leveraged return and build out the assets much quicker that way. Yeah, Jared, we'll get you a copy of the deck for sure. Anybody who signs up for that meeting with me would get a deck in advance. And if you saw the deck and didn't want to do the meeting still, then cancel it and I'll gladly take my half hour back, no problem. But yeah, we can get that out to you for sure. I think the best place to start, though, especially because it's a private issuers thing, is a meeting. That's the best place. That way I can, properly do what's called know your client, the KYC. So we shouldn't be spraying out marketing on this without talking to folks first. Christine, will I be sending out a link to register for the event closer to the day? Absolutely. We're going to do some advertising for it. We'll send everybody who came to this and everybody who registered and didn't watch or who is watching the replay, you will get a direct link to the event. Absolutely. You bet. Cool. Still getting some good questions coming through. Any other questions that you guys have? Burning questions? My pleasure. Well, we're coming up on 90 minutes. I think we did it. I think we delivered. We had ourselves a good little online event. And I look forward to rubbing shoulders with you guys at the investor event in person. And I hope to get a chance to chat with you guys over the phone if you're interested in cash offer. And here to answer any questions you guys might have as well along the way. So don't be strangers. We'll shut her down there. I'm going to end the stream. Thanks again, Jessica. Nice to see you. All right. Bye for now, guys.